Hello, everyone. This is Sebastian McMahon from IA Financial Group. I am again on the road this week, but I'm still here for the weekly economic review, this time for the week ending October 21st, 2022. So let's start with a look at this week's markets at the close on Thursday. So negative again for bonds, so interest rates continue to rise. Now we're at minus 27% for the long bond index. Remember that when the year started, interest rates, or at least the leading rate from from central banks, was at the lowest possible level. And now we've seen one of the fastest and most aggressive hiking cycle in history. So that gives this minus 27% for long bonds, minus 15 for the universe index. Stocks are still looking for direction, but after 4 days positive, on a Thursday we had the positive start to the day, then we lost all of those gains during the afternoon. So market is still looking for a direction, but positive week so far. Year to date, very negative, of course. And oil, Canadian dollar, euro up, price of gold lower. So let's start with the first topic in the UK, quite a week. And this is exactly the topic of this week's podcast, the In Your Interest podcast, which is available on Apple, Google, Spotify, and on the ia.ca/economy webpage. So I strongly encourage to take a listen to that to get all of the details on the situation. But the fiscal plan that was proposed by the new administration of Liz Truss, which was a stimulus at the same time that central banks are doing everything they can to tighten, to hold the economy back, to fight inflation, caused lots of confusion, caused some issues for pension funds in the UK. So they had to make a U-turn. Markets were not convinced, and now on Thursday morning, Ms. Truss resigned from her post as Prime Minister, making her the shortest tenure premier in the history of the UK. So, very interesting development. And again, in your interest podcast, you'll find everything you need and all of the details there. Coming closer to home, inflation in Canada again surprised with its strength. So instead of just showing you, the overall the chart of total inflation, inflation is slowing down, but not convincingly. It went from 7% to 6.9. Expectations were for 6.7% year over year. But when you look under the hood, you see that on a month over month basis, it's still going strong and some components are accelerating. So overall, the most important components of inflation are gasoline. So on the left, you see the price at the pump, which is coming, and the inflation rate is slowing down. So that's a good news, but it's still at over 10% year over year. And in October, we know that gasoline prices went up a little bit again. So the fight is not over. But on the right, the food inflation component at the grocery store, it's still accelerating. Now it's at 10%. And even if it recently in the last week or so, we heard about grocery chains that are looking to freeze prices for a few months. That's going to help with the inflation figure. But again, message is that inflation could slow down, but prices will not fall. They will just rise, but at a slower rate. So it's very important to understand this, that higher prices are here to stay, sadly. Now, next week, as I said, the fight is not over. So the Bank of Canada on Wednesday at 10 a.m., Wednesday, October 26th, they're going to make their new rate decision. They should hike by 75 basis points. And the innovation now, I mean, here, this is what the market is pricing. So market is pricing three hikes next week, so 75 basis points, and three more after that until March. So that means 1.5% of hikes and hiking into 2023. So that's the innovation here. The fight is not over, and likely we won't see peak rates by the end of the year. And now peak rates are starting to approach 5%. So that means mortgage rates could be moving higher to 7, 8% plus. So this is where we're headed. And the most important variable in there, the thing that will be impacted the most and will likely be the thing that helps and that convince the central banks to slow down the pace of hiking could be housing, because housing prices now they're starting to contract and the pace of contraction is accelerating. Last month it was 3% negative month over month. So compare one month to another, you're seeing some strong contraction here. At an annual pace, we're growing at just about 5.5, 5.8% right now. So we're slowing down quite a bit from the 20% pace that we saw. How much will we give back? Of course, in Canada, over the previous 2 years, we had a rise of the average house. The price was up 50%. So 55. So that means that we know if interest rates being very low means 50% growth in housing prices. Now interest rates rising should mean falling housing prices. By how much would it be? 15%, 20, 25, 30? It's still hard to tell, but we should expect some more. So very important variable for the next steps for monetary policy. So what to watch next week? As I said, the Bank of Canada decision on Wednesday morning, 75 basis points is expected. GDP growth in August, no growth during that month, so a stagnation of the Canadian economy. In the US, the Conference Board Consumer Confidence Index should be a bit lower at 105.5 in October. Should have Q3 GDP growth. Remember that we had negative in Q1, negative in Q2, and we had some negative surprises too, so it was below expectations. So let's see if we're able to return to growth in Q3 for the US economy. And finally, core PCE inflation. What's that? That's the inflation that the Fed is looking at mostly, and it should be higher at 5.2%. So again, nothing to convince them that it's time to stop hiking rates. So that wraps it up for the week. ia.ca/economy, your go-to web page. You can subscribe to the newsletter if you haven't done so already. In your interest podcast, again, this week's topic was the UK situation. So I strongly encourage you to take a listen. Economy and Finance 101. There's some new material coming, and you can follow me on social media, Twitter and LinkedIn. So thank you for following us on a weekly basis, and I'll be back again next week.